A terrifying announcement occurred during a major earnings release. The market is so spooked, the stock was sent spiraling down nearly 8% so far. The bears are rejoicing, claiming victory. This is just like the metaverse they proclaim. It has signaled we are officially in an AI arms race among the American tech titans. Yes, Google announced it is investing in its future, investing to reinforce its monopoly and open new streams of revenue. $75 billion in CapEx. Investing is terrifying. Welcome to the Quality Investor. Yet again, Google has shown itself to be a force in earnings. Google's core reactor, which powers the rest of the business, advertising, remained strong, seeing 11% year-over-year growth, despite a second consecutive down year for Google Network. Google Services, which includes subscriptions such as YouTube and YouTube TV, Google Play, and devices, is now a $40 billion business. In terms of revenue, that makes Google Services larger than businesses like Visa, Salesforce, and Netflix. But of course, its newest gem, which shines brighter with each passing quarter, is Google Cloud. GCP is now the business investors pay closest attention to. And Google Cloud is the impetus for the enormous CapEx spend Google is planning for fiscal year 2025. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. $75 billion is a serious commitment to the future. Google is serious about competing in AI and fortifying its cloud infrastructure. That kind of money is more than the GDP of many African countries, more than that of Costa Rica and Uruguay. It is even more than some European countries, such as Croatia and Lithuania. And for this reason, we are seeing this sell-off in the market for Google. Sure, they missed revenue by $200 million, but let's be real. That's walking around money for Google. But on this video, I want to focus on the solid earnings report from Google, the value creation they did, specifically expanding margins in key areas, and discuss why this CapEx forecast is not a black hole, but can potentially being the key point here, potentially set up Google for even better growth in its various businesses and lead to great returns for investors. This is a part of Google's earnings release. I don't want to focus a whole lot of time on the earnings release itself. I just want to point out a couple things. These are quarterly numbers for Q4 and total revenues of $96.5 billion. That's a year-over-year increase of 11.8%. Google Cloud with almost $12 billion in quarterly revenue at Q4. That's up 30.9%. Google Cloud is accelerating its growth. More importantly are the annual totals, though, for each of these revenue segments. Google Search was up 13%. YouTube Ads up 14.7%. And you can see Google Services as a whole, $84.1 billion in quarterly revenue, had $304.9 billion in total revenue and was up 11.9%. And the new star of the show, Google Cloud Platform, up 30.7%. To me, the real important details, though, and what is lost in Google investors that sold after earnings, was the incredible margin expansion we saw. Margin expansion, of course, is a result of the massive investments Google has been making to make their operations more efficient over time. A result of CapEx spend from years ago, and why I believe the CapEx going forward will be a big boon to Google, not a hindrance. More details on that in a bit. But Google Services operating margin in 2023 was 35.17%. Its operating margin in 2024 jumped to 39.77%, 460 basis points. That is a massive jump for a business the size of Google's. And even more impressive is the operating margin on Google Cloud. All the CapEx spend Google has been making over the last decade that has freaked investors out, bulk of that has been going to building out its cloud infrastructure. It finally became profitable in 2023. It had an operating margin of 5.19% in 2023, and its operating margin in 2024, 14.14%. 195 basis point increase. This demonstrates Google's operational efficiency and its ability to generate higher ROIC on its CapEx investments. Looking at Google's high-level fundamentals, everything just looks very solid. Unbroken revenue growth year over year, 18.2% CAGR revenue growth over the last 10 years. Gross profit has gone up over 17.5% annually over the last 10 years, and very consistently as well, if you look at each of the period breakdowns. So solid growth in every important metric for Google across the board. Earnings per share, free cash flow, operating cash. Now, Google does pay a very high stock-based comp. I have very mixed feelings when it comes to stock-based comp. I understand it's an expense. I want to account for it. Perhaps I'll do a video on stock-based comp in the future and what it means to free cash flow. But very generally, my feelings are mixed on the topic. Despite that, we can see the free cash flow per share on an adjusted basis, taking out stock-based comp, has also increased very nicely. And before we get into the CapEx discussion, I want to point something out here on the market capitalization chart. In fiscal year of 2014, Google had a market cap of $361.5 billion. They made substantial investments in CapEx in that year. In fiscal year of 2017 and 2018, Google had $731.9 billion and $726.8 billion in market cap, respectively. As of the close of their fiscal year 2024, on December 31st, Google's market cap was at $2.31 trillion. And today, despite the pullback in the market, Google's market cap is at $2.34 trillion. Massive capital expenditures occurred in these years, and just look at how that has paid off. Here's that capital expenditure I was talking about. They made $11 billion in CapEx in 2014. That was actually 84.6% of their NOPAT, their net operating profit after taxes. 2017, $13.2 billion in CapEx. 2018, $25.1 billion. 2017's CapEx as a percent of NOPAT, 97.9%. And at 87.6% in fiscal year of 2018. Massive CapEx expenditure as a percentage of their profit after taxes. Just last year, Google spent $52.5 billion in CapEx, 55.9% of their NOPAT. What this is telling you is that this CapEx spend, largely for their cloud infrastructure, in fiscal year 2014, 2017, and 2018, has resulted in massive increases in profit, where they're spending $52 billion in CapEx last year, and it's barely scratching 56% of their NOPAT. And it's expected to go up again next year to $75 billion. A pretty large increase. But guess what? NOPAT's also going to increase. Probably not by 47-ish%, but it will increase. Meaning that CapEx percent will not reach these levels. 80+%, 90+%. And just looking at the profitability of Google over the last 10 years or so, you can just see how these margins have done a great job of expanding. Gross margin is down slightly, 62% in fiscal year 2015, now at 58%, but it's trending back upwards. Operating margin, on the other hand, has increased very nicely since 2015, now sitting at 32.1%. And you can see right along with it, so has the return on invested capital. We had ROIC of 14% in 2015. Today, ROIC is at 33%. Double that. Capital expenditures, how businesses invest for the future. And if they invest properly, have strong managerial discipline, and they invest in projects that have a high return on that capital relative to what they're paying to that capital, the business will create value. The business will create more cash in the long run for investors. And that's exactly what Google is doing. And I fully trust Google's management to invest in the proper things in 2025 that will further push this ROIC even higher. They're obviously investing to further fortify their cloud infrastructure, as well as investing for the modern world, which is AI. Google wants to be a player, and they're investing like it. To me, this tweet sums it up nicely. From Joseph Carlson: lots of people seem to misunderstand the business of cloud hosting. This isn't some speculative bet on AI gimmicks. They're building out the infrastructure for the modern world. Every business needs comprehensive tools for hosting, infrastructure, storage, and compute. Building out large-scale, geographically diversified infrastructure to handle these demands are initially expensive, but the returns on it have been phenomenal. And we can see that in the Google Cloud margins. It's obvious. It's right there for every investor to see. Look at AWS margins as an example. By the way, AWS is the most profitable of the cloud infrastructure. Their margins are nearing 50%. Google's trying to get there. This CapEx spend has a predictably high ROI, and revenue for cloud was growing quickly long before AI and LLMs ever entered the mainstream. We're just touching the surface of what Google can do. And to that point, what is a good buy price for Google right now? In terms of estimating Google's DCF for the next 10 years, here's some of the assumptions I'm making. Operating margin growing to 33.5 in year one, or 2025. Over the next 10 years, I expect that operating margin to be about 40%, and in a bull case, 42.5%. This is based on margin expansion for Google Cloud, as well as a little bit lower margin expansion for Google services, things like search, YouTube ads, and whatnot. And of course, then taking a mix of those two. In fact, I might be lowballing it a little bit. If Google services has a 42.5% margin next year, only expanding that margin by about 3%, less than what they expanded in 2024, and Google Cloud expands to a margin of 18%, Google's operating margin will be at 34.5%. I'm lowballing year one, and I'm definitely lowballing what it'll be in 10 years. Google pays a very low income tax percent, estimated here at 16.5% in year one. Free cash flow conversion. Now, this is much lower than their 5 and 10 year averages, 69 cents for 2025. Of course, I'm counting for the fact that they're spending $75 billion in CapEx. I'm anticipating Google's dividend to grow to about 89 cents next year, which would be about 15% growth. And on a bull case, Google's dividend growth could probably be about 17%. It might be even higher because they're just starting to pay their dividend, and they have a very low free cash flow payout ratio. It's at 8.8%, a lot of room for that dividend to grow. Total revenue grew at 16.7% over the last 5 years. My base case assumes revenue growth of 8.3%. We all know Google is going to grow at least 10% over the next 10 years. Bull case at 11.2%. Google search growing at 8%, YouTube ads at 7.4%, Google network at 1.5%. But the big one here is cloud. A lot of analysts are projecting Google Cloud growth at nearly 20% annually for the next 10 years. Some are projecting 30% growth for the next 3 to 4 years. My projections here are based on 13.8% on a base case for Google Cloud, 18.8% on the bull case. So by year 10, I assume operating income will grow about 10.7% annually, expanding to that 40% margin. Net income will grow about 10% annually, expanding to a margin of about 33.5%. But most importantly, I expect free cash flow to grow at 12.2% annually, expanding to a margin of 29.5%. Now, I'd said that I'm expecting free cash flow to be about $75 billion in 2025. Add in that $75 billion in CapEx, that means I'm expecting operating cash to be $150 billion. Looking at Google's operating cash on a 10-year basis here, it's grown 18.5% over the last 10 years annually. And it's not volatile at all. 12.65% volatility. And you can see it's very consistent in its growth. This is very rare for a business, especially one the size of Google. And in fiscal year 2024, its year-over-year operating cash growth was at 23.15%, $125 billion in operating cash in fiscal year 2024. I'm projecting $150 billion in fiscal year 2025. That's growth of 19%. And you take out that $75 billion in CapEx, and you're left with $75 billion in free cash flow. Free cash flow was at $72.76 billion last year. I'm actually projecting free cash flow growth, despite the fact they're outlaying $75 billion in CapEx. They've grown at 10% annually at 19.74%. So none of these projections are wildly out of line. If anything, they're conservative. On the bull case for free cash flow, I have it growing at 16.2% annually over the next 10 years and bringing it up to a margin of 32.5%. As of this recording, Google's trading at $189.65, PE ratio of 23.6, and a forward PE of 21.3. Slightly above their 5-year average, but the PE ratio is slightly below their 5-year average. This is a screaming deal, in my opinion. On the bear case, I have a DCF of $187.59, $256.29 on the base, $349.92 on the bull case. The dividend discount comes in at $161.62 on the bear, $215.59 on the base case, and $306.50 on the bull case. The exit multiple is at $293.83 and based on comps of Meta, Microsoft, Netflix, Apple, and Amazon. Every single valuation average, bear, base, and bull, there's upside. almost 10% for the bear, 34.7% upside for the base case, and 71.4% upside on the bull case. The buy price without any margin of safety right now is at $260.92. That's a forward PE of 29.3. A 10% margin of safety, $234.83. A 20% margin of safety, $208.74. A 30% margin of safety is $182.65. We're nearly down to the 30% margin of safety level here. Google is a screaming buy right now. I added more yesterday, and I'm highly considering making it the largest stock in my portfolio. Right now, Microsoft is the largest. Google's not far behind, but I think there's a lot of potential here in Google. Now, this is a discussion for another video on another day. I was initially concerned about some of the DOJ actions against Google, trying to break up the business, having them sell off the search business. I'm a little bit less concerned with that now, just due to the fact that the new Trump administration seems to have a different set of priorities, and they don't seem to be going after the tech industry and looting their coffers like the Biden administration did. That remains to be seen, but I think it's a lower risk than it was maybe 3 months ago. So I added more to my position. I'm going to continue adding more to my position, and I think there's a lot to like about Google going forward. Thank you for watching today's video, and if you've made it this far, go ahead and subscribe to the channel. Thank you, and happy investing.